welcome to a fresh new session on credit risk modeling using SAS. Uh, so we'll start off from the sessions, start off from the point where we left off in the last class. So just quickly revising up the stuffs that we were talking about, right? So in the last session, we started talking about the BASEL portfolios. We are talking about the different kinds of portfolios, right? So we saw that a banking book is comprised of two parts. One is the retail lending book, the other is the commercial lending book, right? Now, in the retail lending book, it comprises of products which are given to the retail sector, to the households. So, generally, since there are a large number of households, right? So, a number of accounts in the retail sector is very large, or in the retail products is very large, whereas the per unit exposure of a retail loan is very less. So what we saw over there was the following, that basically when we are working with retail portfolios, one very important characteristic of a retail portfolio is that this portfolio has large number of accounts while the average exposure per unit of account is very less, right? And under retail portfolios, there are three broad sub-portfolios which Basel has defined according to the exposure that it has and according to the nature of the business product that is there. So, talking about the Basel classification, Basel subdivides the retail portfolio into three parts. One is your QRRE, the other is mortgage, and the third is the other retail. So while talking about QRRE, right? So one thing that we saw over there was that QRRE comprises of revolving products like credit cards, overdrafts, etc. Now, talking about these products, a very important characteristic of the retail product is that it's an open-ended product and is an unsecured lending product in the sense that there is no collateral associated with it. So when I'm taking a credit card, I need not mortgage my house or any banking paper. So it's a very free or a very flexible kind of a loan product that we can actually use. Now, having said that, right? So the next thing that we need to that we have looked into is that for the second type of the sub portfolio, which Basil talks about, is the mortgage portfolio or the housing loans, right? So loans which are given to buy houses or real estate property. So now, when I'm talking about mortgage loans are purely collateralized loans. So these are loans which are used by the bank. These are loans which are used uh, which are taken to buy houses, and these loans are purely mortgaged by the what should I say, by the home, by the house that people buy. Now, talking about the third portfolio, the third is the other retail portfolio. The other retail portfolio comprises of term loan products, right? Loan products which may be unsecured or secured, but is but has a fixed term. So over here, so these are the three broad categories under which your models or your portfolio may be falling. Now, coming to the next part that we have over here, the second set of the lending books of the bank comprises of commercial borrowers. Now, talking about commercial borrowers, there are two broad type of commercial borrowers that we generally come across. One is a small and medium scale enterprise, which is SME, where the total turnover is less than 50 million euro, where and for corporates it is greater than 50 million euro, right? And within commercial products, there are different kinds of products such as object finance, vehicle finance, highly volatile real estate portfolios, and so on, right? So these are the two broad lending books that Basel has, and we have seen that for each of these portfolios there are these three core models which are developed, right? So one of the model is the probability of default model. The second type of model that we talk about is the loss given default model. And the third type of model that we talk about is the exposure at default model. And when these three together comes together, what we get is our expected loss, right? And we have seen the criticality of expected loss as a concept, right? Because we've seen that all unexpected loss, and then going forward, capital reservation, capital reserves, and all everything is built based on this expected loss concept, right? So over here in today's discussion, right? So in the last class we had laid down the framework for the PD model, the LGD model, and the EAD model. Now in today's discussion, what we'll talk about is we'll take up each of these models in greater depth, right? And we'll explore each of these models for each of these different kind of products. Right. So basically, we have been talking about two broad products, right? So one of the broad products that we talked about was the QRRE, or the qualifying revolving retail exposure. The second that we have, the second product that we did talk about was the personal loans, right? The personal loans, which is unsecured closed-end product, and for which we generally pay a fixed EMI. And given that we pay a fixed EMI, right? So therefore, it's a fixed contractual cash flow, and the loan is amortized over a period of time. And personal loans fall under that branch of assets, right? Which has a fixed contractual cash flow, which is classified as SPPI under IFRS 9. So when we come to IFRS 9, we will be talking about this in more details, right? When we talk about asset valuation, when we talk about assets value, like valuation of assets at fair value, other comprehensive incomes, and so on. So these are some of the things that we have started talking about. So over here, coming to the next part, right? Coming to the next part. Uh, so in today's discussion, we will be focusing more in greater depths on each of these models. The PD model. We'll talk about the LGD model, and we'll talk about the EAD model, and we'll be comparing. Given the different objectives of each of these models, we'll be comparing on the different type of exclusions that would be relevant, the different kind of modeling structure, the modeling methods that would be relevant. We'll be talking about the different kind of observations that would be relevant. What are the different kind of stuff that are there? So we will be talking about most of these, and we see that as we talk about these for each of these models, right? Uh, the target variable for these models, for the EAD model, and also they keep changing over a period of from product to product. The sources of riskiness for the products also change. So basically, we'll start talking about. Let's start by discussing about the concept of probability of default, right? So what is this probability of default? In the last class, we saw that the probability of default is nothing but the chances. It is just to estimate the chances that a borrower will default in the next 12 months, right? So over here, so basically one thing we can very clearly see is that this PD model that we are talking about over here is a purely behavioral model, right? So we have a purely behavioral model over here. So is LGD and so is EAD. So over here for each of these cases, what we have is we have so basically all these three groups of models that we have over here for computing expected loss are pure behavioral models, right? So what are behavioral models? So behavioral models are models which assess or which are used to develop which are developed to assess the behavior of the borrowers, right? So this is the next thing that we have, or rather, this is the thing that we get to see over here. Now, coming to the next point over here. So coming to the next point, right? So we need to distinguish between the acquisition PD and the behavioral PD. So basically, you know, PD as a concept, of when we talk about probability default as a concept, it is essentially a behavioral concept. But and in Basel PD, right, acquisition scorecards or acquisition PD or origination PD is not really very important. So Basel looks into the PD after the borrower has been originated on the books. However, the role of however, acquisition PD has a very significant role which it can play under IFRS 9, right? So that is where we need to have a better, and that is where we need to have a clearer understanding of the Basel PD model. So over here, let's try to better think about this part. So what is acquisition PD? So let's take the case that there is an applicant. So there are some applicants who come into the bank to ask for a loan. So this is what we call the through the door population. So this is what we call the through the door population. Through the door population comprises of the set of all the possible accounts which have come to the bank asking for a credit. Now what happens is, so there are two borrowers who come in asking for the loan. So what is the business problem of the bank? What the bank tries to understand over here is that y equals to 1 if the borrower is good. Right, so if the borrower is good. Is equal to 0 otherwise. So now, if I want to hire a customer, if I want to acquire a customer on my books, so what will I do? I would always want to know what is the probability the borrower is a good borrower. So what we'll do over here is the probability of y equals to 1. Right? So this is where the this is what is the probability of y equals to 1. So when I talk about the probability of y equals to 1, right? So what is this? So over here, what I'm trying to assess is what are the chances that the borrower becomes a good borrower. So what is the complement of the fact that the borrower is a good borrower? It is that the borrower is a bad borrower. So y equal to 0, which is nothing but 1 minus probability y equals to 1. So over here also I get an estimate of the borrower to default, right? But what is the basic difference between this PD that I have calculated, which I call over here to be the acquisition PD, called the acquisition PD, right? So this acquisition PD that I call, so what is this acquisition PD? Now, one very important factor is that this acquisition PD is not based on your behavioral factors. So this acquisition PD is essentially based on the behavior in previous credit. So the acquisition PD that I have over here is based on the behavior of the borrower in other credits. So basically, if I had taken a personal loan and I had defaulted, right? Or I had missed out quite a few EMIs which I had paid back after some point of time. There was a guarantor who had paid that. Then, when I go to take an auto loan, right? The for the bank before they give the auto loan, they think, okay, this guy has a higher chance of default compared to that guy because it is this guy who took the money from us the last time but did not pay back. Had it not been for the guarantor, we would have been totally lost out. So we would have lost out on his money. So therefore, when I'm calculating the acquisition PD, I am computing it based on the origination factors, right? And I am not computing it based on the behavior or the performance in that particular credit. So therefore, the acquisition PD is based on the behavior in other credits, right? Anirudh, clear? Great. Now coming to the behavior PD. Now when I talk about the behavior scorecard or when I say that PD is a behavioral model, right? So it means that say suppose I'm modeling the probability of a borrower to default for the auto loans portfolio. So then what will happen? So then this borrower, what will be the case for this borrower? So for this borrower, what would happen is the following. So this borrower would see that there are chances of, say basically this guy taken a auto or has taken the auto loan and he misses out on a payment on of the auto loan. So then what happens? So when he misses out on the payment of the auto loan, right? So then the borrower becomes delinquent and then his chances to default is assessed. So in a behavior PD, you are assessing the behavior of the borrower in that particular credit, and based on that you are assessing his probability of default, unlike acquisition period, right? So Basel models, so Basel or any such of the regulations of this type, so what they try to look into is when I'm computing the expected loss, they're not concerned about the borrower at the origination. What they want to know is that what are the chances that this borrower might default in the next 12 months, because I'll be giving aside capital in the next 12 months. So therefore, what they plan to do is they try to assess what are the chances the borrower might default in the next 12 months. And that is solely based on the behavioral variables that the borrower has, or on the behavior of the, or the way their behavioral variables behave, right? So, however, however, this acquisition PD gets a very important role to play under IFRS 9. So before I move on, I'll just take up Anirudh's question. I will explain the behavioral variables, right? So for example, say suppose I am paying my loan, right, or EMI every month, and then I become delinquent in a month. So why have I become delinquent? Because I did not pay my EMI. So delinquency actually captures the behavior of a borrower, and hence delinquency is a behavioral variable for us. Right. Say for example, on a credit card, utilization is a behavioral variable because it shows how much of spending, how much of the balance are you spending on the card, how much of the balance on the card are you actually spending on. So that is where this particular concept comes in. Clear? Great. So acquisition PD and behavior PD comes in very handy in when we are developing models for IFRS 9. So by comparing the behavior PD and by comparing the acquisition PD of an account, I can try to identify, or it may be possible for me to identify a credit degradation, right? Now under IFRS 9 as a regulatory, as a regulation, now we know that IFRS 9 is uh, it's the provisioning regulation that banks are looking to get compliant to. Now, if banks are getting trying to, if banks are trying to get compliant to this, then what will happen? So then what will happen is the following: that so when the banks try to get compliant to IFRS 9, so they would need to frame an idea or a preemptive idea about the credit degradation. They need to be very predictive about the nature of the borrower to undergo a credit deterioration, right, or a credit downgrade. And to identify this in a very preemptive manner, IFRS 9 had introduced the concept of the staging analysis. Introduced the idea or the concept of staging analysis. Now, in a staging analysis in IFRS 9, what happens is, so IFRS 9 says that, or divides the credit life cycle of a borrower into three stages, right? So over here, the first thing that we talk about over here is stage one. So the stage one, a borrower is an active and a non-delinquent borrower. An active, non-delinquent. So over here, what we have is an active and non-delinquent. So basically, over here we have the staging analysis, right? So over here, stage one is the case where it is active and non-delinquent. So the guy is not being delinquent at this stage. After that comes stage two. So in the stage two, or IFRS 9 defines the stage two as a point where the account has been delinquent. So the account is at least a CD1. So delinquent, but not defaulted. Delinquent, but not defaulted. So basically, this is where staging analysis comes in, right? So stage one is active and non-delinquent. Stage two is delinquent but not defaulted, and stage three, according to IFRS 9, is or the stage three in so according to IFRS 9, when a borrower is in stage three, what happens is the borrower is an impairment, or it's an impaired account, so it's a doubtful loss and you have to keep aside 100% provisions against it. So I know that the account is mostly lost, so whatever amount has been lost, so that amount needs to be kept back aside as provisions, right? So this is the stage of impairment, right? So basically, if I think about where these three stages simply, right, what you will observe is the following: that as you move from stage 1 to stage 2, right, and stage 2 to stage 3, you actually undergo a credit deterioration. So there is a credit deterioration. Now if there is a credit deterioration, right, so then what we need to assess is Why is that deterioration? So over here, what we have is a deterioration, right? So the question that comes out over here is that how is it that IFRS 9 defines this deterioration? How can I define a deterioration in the stage of a borrower? How do I do that? So that is where this concept, or that is where this question actually comes in. And to answer this question, right, one of the ways to answer this question is to use both the acquisition PD and the behavior PD together, right? So basically, the idea is that at acquisition, you are at a higher ordinal rating bucket. Now, following this behavior, right? So you took a loan, then you went delinquent and all. Your PD has now increased. So at acquisition, you had a PD. Now say after 5 months or 6 months of operation you have a higher PD. So what you see is that your PD has degraded from the acquisition PD. So now you are a relatively more risky borrower than you were at origination, right? So obviously what we can say is that you have undergone a credit deterioration. So as I move from stage 1 to stage 2 and stage 2 to stage 3, as I undergo credit deterioration. So the question that comes out is that how do I identify a significant increase in the riskiness of the borrower, a significant increase in credit risk? How do I identify? Right. So basically, the question that IFRS 9 comes up with is that compared to Basel, where Basel says that okay, we will keep aside the next 12 months loss. IFRS 9, since it's a very specific provision, right? So it's a provision driven or reporting standard driven model. So what it comes up and tells us is that man, if you have to, reserve, if you have to keep aside a certain amount of expected loss from your account, what you need, you were just keeping it aside for 12 months, for the next 12 months doesn't make much of a sense. You need to ensure, you need to be very preemptive and very conservative in your in your provisioning policy. So what you need to do is you need to assess a significant credit deterioration. Now if there is a significant credit deterioration, what you will do is you will compute the lifetime expected losses. And if the account doesn't has not gone through a significant credit deterioration, then you just compute his next 12-month expected losses. So basically, it is seen that for accounts in stage one, so under IFRS 9, for accounts in stage one, the next 12 months ECL is computed. Right? So the 12-month ECL is computed over here. Now for stage 2 and stage 3, where an account has gone a significant credit deterioration and it has entered from stage 2 to stage 1, then you do not compute the next 12 months. So what they suggest over here is that you should collect, so you should actually calculate the lifetime expected credit losses for these two stages. So over here what you need to do is you need to develop a lifetime So over here, what we are doing is we would be talking about lifetime expected credit losses. So another important thing that we can see with IFRS 9 as a reporting standard, that it very granularly decides or talks about the varying riskiness of the borrowers, right? So over here, credit loss. Clear? So over here, since we are computing two different estimates of expected credit loss based on the impairments, therefore I need to find out a very distinct staging criteria, very robust and distinct. Uh, yeah. So as I was saying that over here, what we get to see is that there is a staging which is done, right? So borrowers are looked from a more granular perspective this time. So over here what we are trying to or over here so what is being done is that if your borrower is a stage one, that is it is a non-delinquent and active borrower, then for those set of accounts we compute the next 12 months expected credit loss. On the other hand, when I talk about the stage 2 and stage 3 under IFRS9, what we get to see is that there is a new lifetime expected credit loss measure which is coming in, and that is where this so basically with this new regulations coming in and all, so the next thing that we need to know is that how is it different from the existing Basel regulation, and it is because of this granularity it would help the bank take a preemptive action, right? So this is what the overall idea was under staging analysis. Now, how do I identify that a borrower has moved on from stage 1 to stage 2 and so on, and stage 2 to stage 3? So to do that, one way to identify it is that I compare his acquisition PD to the present behavior PD, and if I see that he has gone down by a certain percentage, then you know that there has been a degradation in the overall credit risk, right? And for stage one accounts, you compute the next 12 months ECL, whereas for the merit accounts, uh, like and all the for all the degraded accounts, what we talk about over here is the lifetime expected credit loss accounts. So this is precisely why we would require these two separate measures, because since IFRS 9 is a regulatory framework which talks about provisioning, right? Therefore, it has to be very preemptive and very granular in identifying impairments, because they need to keep aside provisions. On the other hand, for a Basel model, all we are concerned about is what is the portfolio level expected loss. So I am not interested to know that whether there is lifetime loss or not, because even if there is a lifetime loss, right, I would not be putting aside the entire amount in today's date. So over there, if I am developing a lifetime expected say a PD model, right, and then you compute. So basically, just imagine that if I compute the lifetime expected loss and I keep aside it at this point of time, just imagine the uh, the amount of uh, so what should I say that, say if I find out the lifetime expected credit loss from an account and I keep aside that money today, so I would obviously be running out, or there would be a very severe opportunity cost of these. Uh, so basically, this is where so this is where it becomes. Yeah. So as I was saying that, so if I put aside expected credit losses, right, so over a period of time, so I find out the lifetime losses and reserve for that entire in today's date, then at one point of time the capital reserve would suddenly go up very much, and then for cases when then that kind of thing do not happen, that will fall. So so when I'm trying to keep aside capital over here, right? So when I'm willing to keep aside capital in a bank, right? So that has to be very stable. So it's not that today I keep aside all the lifetime expected losses and then the capital reserve goes up, and after some days what we see is that again the capital reserve has gone down, some capital is being released and something is being done. So that creates a volatility in the capital structure. So in a capital, so when you try to keep aside capital, I have to always do in the next 12 months loss, because I am doing the capital reservation on the next 12 months loss basis. Right. So this is the reason why Basel looks into the next 12 months loss, whereas IFRS 9 looks into the lifetime loss and the next 12 months expected credit loss as well, right? So is the difference between these two regulations like the treatment for the losses, like the time period over which the losses are computed and the definition of the losses that are generally used. So is this idea clear? So since Basel is a capital reservation model, right? So it would always be looking to maintain a stable amount of capital all over the periods, right? Whereas in provisioning, right, you are more interested to look into the granular because you know that if there are no such granular movements, then you can always release up some amount of profit to be shared for that particular year. So, so that is basically the difference, right? So the basic objective with which the Basel and the basic objective with which the the IFRS9 was created. So those are two totally separate kind of a topic. But again, the input which enters into the model is or the broad classification of the input is more or less like so basically that is why when we get to see that the classification of the variables and the way the two regulators treat the same thing, the same model is very different, right? So the LGD model for the uh, so so as I was saying that okay, just give me a moment to kind of reframe my thoughts. Yeah, so as I was saying that so when so both these models they operate with different types of objectives, right? Both the Basel and IFRS, but the nature of the input which are entering into the two model is same. So for IFRS 9 you require the PD LGD estimate to complete the expected credit losses. On the other hand, in Basel, what we need to do is we need to know the next 12 months expected losses. So there is a conflict between the two, right? So over here, what we would see is that even though the three basic models or the business problem associated with the three models remain unchanged, right? So PDs, PD, LGDs, LGD, ADs, EAD, but their approach to these models differ, right? So over here in the next discussion, we'll talk about the basic differences that we generally get to see. Uh, so that we generally get to see between Basel and this particular regulation IFRS 9. So, so over here we look into each of these models from the perspective of the different regulations, right? So till now, is it clear on the? Are you guys clear on the following question, right? So basically, what is the stage of the? What is the staging analysis? Uh, how do you identify this? So, so basically, how is it that like we identify the difference between these two regulations? So, how is it that you identify QRRD? How would you identify retail portfolio, distinguish between retail and commercial portfolio? What are the key important characteristics? Also, what we have also learned over here is that where is it? Why is staging important in IFRS 9? Why is it that we require an acquisition PD and a behavior PD? So, how does that acquisition PD come into into play, and how is it that it is used in IFRS 9? Why is it that the acquisition PD is not used in the behavior models or like so? So over here in the next part that we go in, we'll talk about the probability of default model. We'll talk about the loss given default model and all from different perspectives, right? So first we'll start off with the probability of default model. Okay. So before I move on, there are two questions which have come up, right? So one is Anirudh, the second is Vishal. So Anirudh asks a question that what about the accounts which are only delinquent and not yet written off? So for those accounts, provisions need to be kept. So certain part of those outstanding must be weighted by a estimated loss rate, and from there a certain amount is kept aside as reserve. Right, so it's not 100% provision. So 100% provision is only maintained for accounts which have been impaired. Right, so that is the answer to Anirudh's question. So is this clear, Anirudh? Great. Okay, so coming to Vishal's question, can you explain something more on acquisition PD? So Vishal, over here, the basic concept of acquisition PD is something which I have explained. So it is the probability of default which is estimated at default. I mean, so it is that this is the PD which is estimated at origin. So when I'm actually originating on the books of a bank, right? The bank models my behavior. And the bank sees that okay, this is the guy whom we can give so and so much of loan. So, but when the bank is giving me, the bank is always running a constant risk. But what the bank sees is that this borrower is relatively less risky than what his other borrowers are. Uh, so at that time, based on the affordability and the reliability matrices, the bank computes the probability of the borrower of being a good borrower. Therefore, 1 minus the probability of being a good borrower is the probability of being a bad borrower. So that is what is acquisition PD. Now, how to estimate acquisition PD? What are the different ways of developing an acquisition scorecard? Is something which will be defined when we come to the scorecard development portions, right? So that is where we'll talk very prominently about each of these cases. Clear? Great. So as we start off with talking about PD, right? So broadly, there are two different. Broadly, there are two concepts of PD, or two types of PD measures, or probability of default measures. Yeah. So there are two types of PD estimates that we have. One is called a point in time PD, or a PITP. And the second that I have over here is called uh, and the second that I have over here is called the through the cycle. Right. So the PITPD stands for the point in time. So over here, if I write it like this, point. So PIT will stand for point in time. Right. And TTC stands for the through the cycle period. So this TTC stands for through the cycle. So TTC stands for through the cycle. So the question that comes out is that why do we need these two types of things? Why do we need a point in time PD, and why do I need a through the cycle PD? So if I already have a point in time PD, why do I need a through the cycle? Right. So this is what slide is. So over here, what we need to address next is what is this PIDPD and what is the through the cycle. Now, if you look, so basically, if you just look into the two names, right? One is PIT and the other is the TTC or the through the cycle, right? So if I look into this, uh, you might say a behavior or might say is like a definition word, whatever. So over here, if you look at the first thing, it shows point in time. So the very word point in time over here identifies that it is a short run period. So it is basically what we get to see is it's a short run concept. Right. And when you look into the second term, that is the through the cycle period. So the question that comes out over here is that what exactly is this through the cycle period? So when I talk about through the cycle, it clearly essentiates or it clearly says that it is a PD estimate which is being comprised of or which is comprising data over a given business cycle. This is only you know so from this term you can actually clearly identify that for a through the cycle period, through the cycle period is computed for a long term behavior, right? So it talks about a very kind of a long term behavior with the accounts. So this is a long run kind of a period. Because when you look into the word through the cycle, you can actually make out that yes, it's a PD estimate which is being constructed with data across a business cycle, right? So that is why it is called a long run period. Yes. So Anirudh, I will be coming to this question. I'll be coming to the examples, right? So basically, when we are talking about a through the cycle PD, right? So what are you trying to do? You are trying to know what is the probability of default over a given cycle. So, for example, say the PDs that we get to see in the behavior scorecard, right? So you see that when macroeconomic scenarios change or when like other variables change, then so yes. So basically, when you see that macroeconomic variables or the other variable changes, then the point in time PD also changes, right? So this is a very temporary measure of PD and it keeps on changing with changes in the macroeconomic scenarios. So, however, if I incorporate all the macroeconomic scenarios and if I develop a model, right, using a very long term data in my system, then that PD which changes in the macroeconomic situation is known as a point in time PD. And so through the cycle case over here is so over here what we have is the long run case, right? So if I talk about long run, so that estimation has to be very stabilized in nature. So given the fact that so as I was saying that given the fact that like thinking about from the BASEL perspective, right? I would always see that it is a long run. It's that kind of a long run PD, a PD which remains more or less constant over the years. So that is a long run PD. I mean, that's a through the cycle long run PD. Now, okay, so over here we need to understand two very important concepts over here. One is So one over here, one thing that we need to keep in mind is that when we are developing the through the cycle models, right? So then, just hold on. Yeah. So as I was saying that, so when I'm trying to develop a model, right, I want to develop it through the cycle PD model. But problem is that for most of the region portfolios, most of the variables that we have are uh, so basically the PD that we are estimating over the year or over that time, over the entire period of time, we use a business cycle and all, right? So then one uh, So what should I say? So one very important challenge is that it is very difficult to find actual variables which are through the cycle in nature, especially in products like especially in in different kind of products which incorporate the retail and the commercial portfolios, right? So basically in products like personal loans, credit card, etc., it is very difficult to find out uh, what should I say? Uh, it becomes very difficult for us to find out variables which are through the cycle in nature. Right, so most of the variables are point in time variables. Therefore, after developing a point in time model, what we need to do is we need to convert it into a through the cycle model. So that is where the role of this PIT actually comes in. PIT, PD, and the TTC PD comes in. Right. So now some TTC variables can be seen in most of these. So some of the for mortgage and all, for some of these products we can get some TTC variable. But so if I'm saying a TTC variable, it means that variable value has to be unchanged over the period of time, over the period of the entire cycle, right? Say for example, in a mortgage portfolio we get to see a loan to value ratio. Now the loan to value ratio is a variable which was taken at application, and that was taken, now the amount of the credit that was taken, so that's a behavior variable. So we do have each of these variables which ensure that the behavior aspect, the behavior risk of the borrower can be captured, right? So but it is very difficult, so it is very difficult that to get pure through the cycle variables. Therefore, when we are developing Basel models, the PD estimate may not be a exact or pure PIT and a pure TTC. It is generally a hybrid estimate, right? So is this idea of PIT, point in time, and through the cycle clear? Any questions up to this point? Okay. So Anirudh, what is not exactly clear over here? So the through the cycle PD estimate is an estimate. So it's, you can think about it as a long run PD estimate, right? A long run conservative estimate of probability of default, which would remain more or less unchanged throughout a business cycle. So if I need to predict such variable, therefore what I need to do is I need to have variables which remain more or less unchanged, right? So this is where through the cycle concept comes in. Say for example, you buy a house, right? So the loan amount for which you have bought the house, or the number of years for which you have taken the loan for the house. So these are variables which are unchanged in nature, right? Now, higher the amount of the loan, or say the higher the amount of duration is considered to be relatively more riskier, right? So based on that, we can actually develop a model. But such existence of such variables which remain fixed throughout the cycle is very rare. We generally do not get to see it. And that is where all the challenge actually arises. And hence, developing the pure through the cycle model is very difficult. Clear? So if you're thinking about through the cycle variables, think about variables which would not change over the entire business cycle. So if the variables do not change, right, and you get a PD estimate through, so if the variable's movement is independent of macroeconomic fluctuation, cyclical behavior, then what you have is a through the cycle PD, right? And to ensure that the Basel PDs are through the cycle PDs, there is this restriction on its data requirement that it must be so. So in that case, so basically you are using a long period of data, right, such that it covers all possible loss behaviors, and based on variables which do not change over the cycle, we try to develop a model. But finding out such variables which do not generally tend to change over a model becomes very difficult. So that is the reason why this probability of default. So when we talk about probability of default estimate, we ultimately for regulatory models like Basel, we are going to end up doing a through the cycle kind of PD, which is developed by mostly by business model teams. So so now let's think about in more details about what exactly is the idea of this probability of default. So how did this probability of default occur? Now the framework that Basel follows, right, to describe PD and stuff, so that is or that framework is based on the structural credit risk model framework. So this is based on the structural based on the structural credit risk model. The structural credit risk models. So the structural credit risk model is based on, the very base of the structural credit risk model is the Black-Scholes Norton model, or as we call it, the BSL model, right? And it is this Black-Scholes Norton model which plays a very important role for defining probability. I mean, for defining the probability of default. It actually not only, just shows pop up like, it's not that it just mathematically solves for the probability, but it also helps us capture those variables, those output which are actually impacting a through the cycle PD, and how is it that the through the cycle PD can be converted into a point in time PD, because for provisioning models will require the point in time PD. Clear? So that is precisely the next question. So over here, right, the structural credit risk model that we have, unified, if we start talking about the structural credit risk model, the PSM model, the Black-Scholes-Morton model, right? So that is a very fresh discussion. So we will not be, so let's not go into that right at this moment, right? So we'll start talking about the BSM model in the next class, which is on Wednesday. So Wednesday we'll talk more about uh, PD as a concept, the theoretical framework which Basel uses to derive the PDs, right? And how is it that we can actually work with PID and TTC PD? So how is that expression, or how are the factors affecting a TTC PD identified, and how is it that you can convert the, how is it that you can convert the uh, PID-PD to the TTC-PD, and for that we'll discuss the entire Black-Scholes-Morton model framework and the part from where this probability of default comes in. Right. So this is the next topic that we talk about in the next session, which is on Wednesday. Thank you. So in case of any questions, you can write into me, and expect this recording by tomorrow evening, and we meet at the same time on Wednesday. Thank you. Bye bye.